So you touched a little bit on this, Mark, but let's dig in a little bit more, with you and Mike as to how this crisis will impact the urban environment. And there was a trend where there was more of a migration into those environments prior to the COVID crisis. And how do you see that being impacted now? And what are some of the things that you're, seeing in statistics, but also what people are thinking about as we do continue to head through this and how we come out of this?
Well, some of the things I've been seeing on the office side, because that's predominantly 95% of my work is tenant representation. An example, some of the clients, obviously WIS is one of my favorite ones, but I've been doing all of AT&T's work for 27 years. Do all Reckitt Benckiser's work in North America, L'Oreal in North America, most of some of the medical groups work, Verizon's, T-Mobile. So I have some really great, corporate clients. So we talk every couple of weeks. And what we're seeing is the tenants that are based in New York City are having us take a look at their employee zip code list. And what we're doing is we're breaking down the employees based upon where they live. So say an example is a large money management company in New York City has 1,000 people. So they sent us a whole database of the people. We found out that 350 live in New Jersey, 180 live in Westchester. So what we're seeing of right now, which has been very popular now, is what we call satellite offices. So like Mike had pointed out, we're not sure the company should start spending really a lot of money in terms of changing the furniture and their layouts. So companies are saying, hey, we want these people to work in somewhat of a collaborative environment. We don't want them to be staying home, too much. We want them to kind of getting back to the workforce. The only way we can do it is to find a suburban building that has a relatively built out space, furnished, that I can get in quickly. And we have a half a dozen deals right now we're working on in that format.
You know what's interesting, Mark? I've been on the phone with a bunch of developer clients who have held property in suburban markets, mostly for residential multifamily development. And over the last couple of weeks, a lot of those developments are gaining traction, which might go to show you about kind of the migration to the urban office space potentially because of the pandemic.
Again, I hate to ever use, 9/11 as an example, but when 9/11 first happened, there was an initial splurge of 3 or 4 companies. American Express was one of them, was taking big space out in New Jersey, and they were signing 1-year leases, like at 101 and 103 JFK Parkway in Short Hills. We represented AT&T at the time, which we still do. A lot of their clients are calling them for excess space. Almost every tenant that committed to space was out of the space within a year. And, God bless the people in New York, but within a 3 to 4 year period, they started rebuilding downtown New York City. Yep. And it's probably one of the hottest areas in the city right now, the whole waterfront there. This again is different in our point of view because this affects families, it affects children, it affects parents. And even though 9/11 affected the United States, it was really kind of based in New York City, a little bit in Washington, a little bit in Pennsylvania. This is a national and obviously global issue. So because of that, that's why we're seeing the push to the residential. On the commercial side, Cushman Wakefield represents Facebook, and Zuckerberg, in the paper last week, committed to proceeding with Monahan Station, which is 750,000 square feet, the new train station across from Penn Station, New York. So, again, for that kind of talent, we're still seeing companies looking in New York, but I don't want to mention names because some could be confidential, but there's probably a good solid 10 or 15 companies saying, hey, maybe I can move my back office, maybe I can move my IT, maybe I can move some accounting or finance functions out of the city that don't need to be there. And New Jersey has always been a less costly alternative. I mean, rents, for instance, if you want to take New York as a whole, Hudson Yards is probably the most expensive marketplace, that and Meatpacking. You're seeing rents in that area anywhere from $120 to $150 a foot.
Wow.
As you get to Midtown, you could be in Penn Station for $70, you can be on Park Avenue for like $90. The rents kind of range depending on the building and how new it is. But with that said, in New Jersey, rents, as you know, Class A, the nicest buildings that you're in are probably low to mid 30s. And then you have a lot of older buildings, we'll call B and C, in the mid 20s to low 20s. And those buildings, I think, might see a small push of tenants looking to go there. But again, the requirements we're getting right now are mainly for furnished space, kind of moving condition.
Yep.
In terms of existing tenants, some of the bigger tenants that have large leases are coming up, and obviously, believe in what's happening and things will work out, are making commitments of 8 or 10 years. But a lot of the small sales organization, even some of the hedge funds that we represent, are looking to do 2 or 3 year deals. Rents in New York, as an example, are down as an asking rent, supposedly. You don't see it in the paper, but when you send proposals out, are down about 20 to 25% asking rents in New York City. New Jersey historically lags New York by anywhere between 9 months to 12 months. So we have not seen any really reduction of asking rents in New Jersey. But if you have a tenant that wants space 60, 90, 120 days, landlords are definitely sharpening their pencils. And I think it's going to be very challenging for a lot of these landlords, not only for keeping tenants, because most tenants seem like they're trying to reduce their footprint if possible.
Yep.
Although I think that's a short-term reaction. But a lot of tenants are looking for, hey, if I'm going to provide you cash flow, I'm going to move in the next 60, 90 days, then listen, I want a good deal because we know we're not going to be back to normal for another perhaps 9 months to 12 months.
That's great. Thank you, Mark.
Mike, what's your thought?
Yeah, and I have a couple of thoughts there. I think that everything you said, I think that the markets and what happened after 9/11, heard everybody talking about quality of life. It was about being closer to home, and although I think eventually people started to migrate back into New York, it's a little bit different, right? This is almost like a life and death situation. I think people are going to think about this longer, about their exposure with public transportation and commuting long periods of time and amongst masses of people. This may be different. Treat this as a more permanent solution in the suburbs than in urban markets. Time will tell. But the other thing we tend to see in these times too is flight to quality. I think people will look at the costs of the suburban markets being so much significantly lower than the urban markets, and those buildings that have invested in their infrastructure have the ability to present good quality, healthy environments with all the amenities are going to be really attractive to tenants, and those buildings will benefit. The other interesting thing, with respect to, as you said, Mark, people looking, large companies out in the market, and I've heard about it too, looking for space that they can occupy relatively quickly. We are managing a building that was a single tenant building that had workstations, if you recall. You don't see these much anymore in new build outs. All the workstations have low panels now, right? So way everyone's talking about, what are you going to do? Are you going to put up temporary high panels? And we could talk about that later on in the slide deck here. But you have a space that had older partitions, large, 5 foot, 6 foot high workstations, a lot of offices, and 3 months ago, pre-pandemic, that space was going to be gutted. They were going to remove all that furniture, throw it out, remove all the offices, create open environments. Now all of a sudden, that's become valuable. If you have that environment, people are going to be looking at those spaces with less open space and workstations that actually have that built-in division may actually be attractive again, which is really interesting to see.
Cool. All right, thank you. So as you can see on this chart, which is a great slide that you guys have for us to look at and evaluate and see what the impact has been from a loss of employment and by sector. If you want to take us through this, I think this will be very helpful for us to get a better sense of what the real facts are out there.
Okay, so this came from Cushman Wakefield's market research group. So we have 4 full-time people in New Jersey. We have, close to 500 around the country who just track, buildings availability, market trends. So between March 1st and May 1st, we've seen unemployment jump from 3.8% to 15.3%. So basically 2 months due to COVID-19. That represented about 804,700 jobs. But almost 40% of them were concentrated in kind of 3 industries, which you can see on here: education, healthcare, professional business services, office space. But
Yep.
across the board, definitely there's been a large portion of it. So that's one thing we're really dealing with on a very challenging basis. And the part-time workers and things like that was always an issue. But a lot of companies are furloughing people, looking to reduce the workforce, just try and find ways to reduce some of their cash flow. Now we've been approached by a number of our clients to take a look at how they can reduce the rent. And one of the challenging things is, keep in mind, is like when you pay rent to a landlord, the landlord has to service his debt. So it's like you paying your mortgage, so to speak, right?
Mhm.
So to ask the landlord, hey, I can't pay for a few months, it's, we always think as landlords are being very wealthy people, and but keep in mind, most of these buildings are financed and leveraged pretty heavily, as Alex knows. So a couple of suggestions we have made: obviously, if you have a security deposit, go to the landlord and ask about a security deposit for 1, 2, or 3 months for rent, and paying that back within the next year or so. If you have a termination options for a landlord, the value of the space when they finance it, they only get value to the termination option period, not the whole term. So there are some situations where some of the landlords will say, okay, if you waive your termination option, I'll give you some value for it. But again, you take away a flexibility for yourself. And then the other situation is where landlords who have a short-term lease, landlords are saying, okay, I'll give you some free rent, but give me another 3 or 5 years of lease term. And some tenants are amenable to that, some aren't, because they're saying, hey, I don't know where I'm going to be in 3 to 5 years. But I think what happened, people have been very reactionary, and people were saying, hey, help me out for April, May, and June. And I don't think it's just in April, May, June, as we know. This could be going into definitely early next year. So that's really challenging. So I think that, as well as people just, these labor issues, people just cutting costs, have been really a significant impact on our economy. Where we were successful in a couple deals is where if tenants have free rent next year or the year after, most landlords are allowing you to trade that free rent to move it from next year to this year. So if someone did a deal where they get 2 months every year, we did this with a big engineering company. They had 3 months starting next March. The landlord let us move it to this year. So that's a challenging part. But again, no landlords are looking to just give away rent. On the flip side, if a tenant doesn't pay rent, I'm not a lawyer about this, but if a tenant doesn't pay rent and a tenant landlord puts them in default and it causes a bankruptcy situation, they become a creditor, right? So they'll probably never get the rent. So it's really, I'm sure Alex probably sees a lot of this. On the developer side, it's really a challenging time, and that's what Mike, running our asset management group, probably sees that quite a bit more. I'm representing tenants, so I'm trying to do what's best for the tenants, but obviously the landlords are a major part of the equation.
Yeah, and I would add to that. I do think that we've seen that across the board. I asset manage our group asset managers properties both on the East Coast and West Coast. Pretty much across the board, and it's a very similar reaction that you've had in a couple of different financial crises, where you'll see tenants immediately go to the landlord for the low-hanging fruit, go after that, reduce our rents. As Mark said, landlords are, if they don't get their rents, they can't pay their utilities, they can't pay their taxes, they can't pay their vendors, their property managers, and it's like they can't live like that, right? They can't live without rent for extended periods of time. It just doesn't work. Interestingly enough, I think that most landlords will take the positions that, okay, you need need some help, we're willing to work with you. Everybody wants to work together to get through this thing. People are in general relatively cooperative. Every tenant's financial situation is different. Every tenant's business is different. Some businesses have been able to thrive in this environment and continue to do business and continue to be able to pay rents. Some have struggled. I think, interestingly enough, the PPP money that a lot of tenants applied for and received was a very effective program. I think it enabled a lot of people to maintain staff and to pay monies towards rents. And we saw a lot of that. We saw a lot of the tenants that came to us initially before they got that PPP money asking for help, and then were actually able to pay their rent and didn't need as much help as they thought.
That's a good point, Mike, because they just changed it too, where you had to be 75% for payroll. And now I think the president signed it, I believe today, where they've reduced it to 60%. So I've had some clients ask me about that. And before the rules changed, I said, it's 75%, otherwise, the people who receive the money are not going to get forgiven, because what they're trying to do is, not advise their tenants, but, hey, you should use some of this money to pay your rent, right? But now the rules have changed where only 60% has to be used for payroll. So I think some of the landlords are going to be happier with that because they're going to be able to use more of the PPP money for rent.
Yeah, and I think that's why you see that 80 to 90% in collection in the office side. I do think that and many companies unfortunately had to furlough people, so they didn't have that payroll obligation, and they could use more of that money towards rent. And so, yeah, I think that's a positive for the market for sure.
All right, thank you guys. And
This is a hard to read graph for people, but the purpose of why I included it was just to give people an idea. So if you look at total vacancy, so we break down vacancy by county, and so we're looking at, for people who can't see the slide, we're looking at Bergen, Essex, Hudson, Morris, and Passaic, which is really considered northern New Jersey. We also have these slides for central Jersey and southern Jersey. So depending where you are, we track those. Overall vacancy throughout is about 17.5%. Historically, New Jersey has a very kind of flat vacancy. As bad as things are with unemployment, that might move up to maybe 18.5, 19. That's what our market research is telling us. But you don't usually tend to see a lot of fluctuation. In New Jersey, 8 to 9% is kind of equilibrium for us. So for people looking for space, there's still quite a bit of space out there. I think it's on a case-by-case basis. Obviously the better buildings, if you're looking in Summit, Short Hills, Forest River, Florham Park is, where WIS is, those locations have done well. I think some of the locations that I have had a challenge, I've always had a challenge, is when you get to the South Plainfield, Piscataway. But what has helped New Jersey a lot, and the reason why I provide the statistics is, in the last 18 months, we've seen many office buildings being repurposed. The best example I could probably give you, which is the most recent, is in Teterboro. There's a large facility there, there's an office building. And what happened is, it was on 23 acres. And the tenant that was there was looking to relocate. And theoretically, most of those buildings, vacant buildings, are worth $40, maybe $50 a square foot. But in this particular situation, the industrial market in Bergen County is very, very strong. So Quest Diagnostics has a 23-acre site in Teterboro that Hartz Mountain bought for $92 million, about $250 a square foot for the office building, which is crazy when you think about it.
Wow.
But the bottom line is they can convert that to over a couple million square feet of industrial space on 23 acres. I don't have the exact, they're going for approval right now. So what you're seeing that in Teterboro, in Parsippany, where the Matt Cali campus is, a couple office buildings there are being taken down. They're putting in some residential. So we're seeing repositioning. Livingston Mall, for example, we have the old Macy's, Sears, Lord & Taylor's. There's a plan there to make that a town center with some residential, some retail. So some of these, believe it or not, what has helped New Jersey most recently, these vacancy rates have gone down, is really the industrial factor. I mean, Amazon, the last I heard, we represent an Amazon, Cushman Wakefield, not myself, has over 16.5 million square feet in New Jersey.
Wow.
And they seem to keep taking more. And companies like Rockefeller Development and some of the large industrial landlords have been buying office buildings and basically taking them down and putting up industrial buildings. And you're seeing rents in the Meadowlands. For instance, I know Lincoln Equity is building a 300,000 square foot single story warehouse, tilt up precast panel, and the rents are 18 triple net.
Oof.
So 18 triple net converts to basically an office deal about a $27, $28 gross deal. So that's one of the biggest advantages that New Jersey has had recently. And that's why when people say, oh, I heard vacancy rates in New Jersey are like 24, 25%. There are in some buildings, you can see here in some of the charts, but a lot of the vacancy rate has been going down. And what this pandemic is causing, is going to come out of it, is people, like you talked about before, might not be going to the stores as much. And people get used to ordering online, food, clothing, all necessities. So the warehouse distribution market, which I don't do per se, although our company's very, very involved, we're probably the leader in New Jersey and probably one or two in the whole country, is this very, very strong market right now. And it's really helping push the office rents down, as well as some of the residential repurposing.
Great. Thanks for all that information. Very helpful.